Thank you for joining us today, everyone. We've got a great crowd, and I just did this nice long 4-minute introduction, and apparently nobody could hear me. So I'm going to streamline this. We've got two wonderful presenters today, both the Eastern and Western Division presidents of Trueclarity. Trueclarity specializes in helping financial advisors make the transition to become independent business owners, and they help these business owners operate at peak efficiency and profitability. And today they're going to be walking us through how outsourcing can help financial advisors increase enterprise value. I'm pleased today to be joined by Dan Cronin, the Eastern Division President of Trueclarity, who for over 20 years has worked for major brokerage firms as VP and RVP of Sales, assisting advisors transitioning to independence, while his colleague out west, Shad Besikoff, has held business development and leadership positions in custody, clearing, and asset management for 4 major firms, and has helped large wirehouse teams and independent broker-dealers advisors successfully transition to independence. So you're in great hands for this discussion. Additionally, we're going to be joined by Terry Mullen, the founder of CEO, who will be walking us through a Truelytics software as a service evaluation platform demo, which is the easiest and best way to get a accurate value for your practice and determine areas where you can improve and strengthen your business. Before we get started, a couple of quick administrative items. We're going to leave some time for Q&A at the end of today's session, so feel free to ask any questions in the question section of your GoToWebinar app. Second, this is our last webinar of 2017, and we've had a great run so far, and we are going to be keeping it going in January, so keep your eyes open for our next upcoming webinar invitation. And finally, we are recording today's session, so we'll make it available for you for your review at the end of today's webinar. But for now, I'd like to hand it over to Shad Besikoff to kick things off and walk us through how outsourcing maximizes enterprise value. Take it away, Shad. Please tell me you guys heard me that time.
I heard you.
Okay. Shad, are you there?
You may be on mute.
Can you hear me okay?
Ah, there you are. Okay. Yes, Shad, take it away.
Okay, great. Thanks for the introduction, Kevin, and thanks everyone for taking time out of your busy schedules to join us today to learn about ways to maximize efficiency and enterprise value in your advisory practices. As Kevin mentioned, my name is Shad Besikoff. I'm joined here by Dan Cronin, who together have over 50 years in leadership and as business development professionals working for some of the major asset management and RA custodian firms. We've worked with hundreds of RAs from small to large. Many have gone from solo practitioners to super ensemble, multi-billion-dollar firms. Over the years, we've found that firms at various stages in their growth hit crossroads in their business, and what we find is that they typically are limited in their capacity to grow. They want to transition their practice into a business enterprise, and practices may not have the staff who are skilled and dedicated at running a business as they are focused on serving their clients, or RAs may not want to manage employee turnover in critical roles. One solution to managing to scale and profitability is outsourcing to professional advisor management companies. Before we dive into this, the reason professional advisory management companies exist is, according to Cerulli's 2016 study, 46% of the time advisors spend with clients, 8% of the time is on sales, and part of that is just on existing client referrals. And the other 46% is spent on the minutia of running the business. For example, vendor management and integration, payroll, HR, billing, reporting, health benefits, etc. If any of you, for example, own an apartment building or private or public REITs or other commercial properties, it's highly likely that you are collecting the rents, dealing with the maintenance. It's highly likely that you're not collecting the rents, dealing with the maintenance, E&O insurance, etc., because you're probably paying a professional management company to do it, whether you know it or not. This is really not dissimilar to running an RA practice and hiring a highly experienced team at a fraction of the cost of hiring the people directly who are skilled and dedicated to the running of your business. And let's take a look how this kind of stacks up financially. To create some framework for our discussion, InvestmentNews identifies 4 different types of firms and the desired state in terms of transitioning a practice into an enterprise and maximizing enterprise value. Is really to move along the continuum from a solo practitioner to a super ensemble firm with 10 million or more in revenues. This doesn't mean that for you solo practitioners out there, it doesn't mean that you can't earn a high multiple of EBITDA or EBOC, but on a relative basis, a 6 times multiple on 600,000 in revenue versus 6 times on 10 million is vastly different, and I think you'd agree. Most importantly, advisory firms today fall into the solo and ensemble space. We'll refer to ensemble firms as those who have more than one professional. Ensembles are the fastest growing category that represent organizations who are transforming from an individual practice to team-based firm, as well as are highly productive and quickly advancing towards an enterprise ensemble. Let's take a look at the numbers on the next slide. To better understand enterprise firms and their financial management characteristics, I've provided a category of top performers, and as you can see, their operating margins were almost 21% higher than all others. In this year's study, 2017 study of top performers, the top quartile of all participants in the 2017 InvestmentNews study were inherently the most profitable in the business and demonstrated an ability to produce profit margins above 40% in 2015. On a relative basis, their expenses and overhead are in line with other firms, yet the industry's top firms, notwithstanding, often rely on highly productive partners to attract and oversee key and ultimately larger accounts than all other firms. They also tend to outsource where they can because they realize that non-revenue producing activities are not core to their productivity and can be allocated to professional management companies whose expertise is running the minutiae of the business. Think about it. Let's say that we calculate about 1,900 or 1,920 hours of work hours in a year. And as an owner of your firm, you're trying to maintain, like in this example, revenues is 4.6 million. So you're trying to maintain 4.6 million in revenues. So if you divide 4.6 million divided by 1,920 hours, that's about 2,395. Let's just call it 2,400 per hour. So would you rather operate at the top of your professional designations and licenses for that amount of money, or spend time managing the minutiae of your business? I know what I'd rather do. So let's take a closer look in terms of profitability and human capital overhead expenses, because that's a key component to this. Top performing firms have profit margins in the 65 to 70% range. For those who came out of wirehouses, a lot of the firms we work with ultimately started at a wirehouse and kind of grew out of that. But for those who came out of wirehouses and had a 35 to 45% payout, this would be the equivalent of a 70% payout and also being a 1099 RA business owner. The point of this slide, however, is to demonstrate that overhead increases as AUM and revenue increases, regardless of whether you're top performing or not. And as we'll see on the next slides, or a few slides, I'll show you why. So this is a slide showing how headcount increases when AUM and revenue increases. When an ensemble earns less than $1 million in annual revenue, they typically have one owner advisor, one non-owner advisor, and one administrative professional on staff. Ensembles at the $1 million to $2 million revenue range show a propensity to add a second non-owner advisor to their staff, along with one or two additional administrative support professionals. When an ensemble reaches beyond the $2 million annual revenue threshold, a new owner advisor is usually added to the equation. The challenge is, for those who hire your own human capital, the expenses start to add up, which can erode margins. This is why, again, outsourcing, regardless of size, can be the right solution. To demonstrate this even further, let's take a look at some of the compensation needed to hire staff to add capacity as revenues increase on the next several slides. So this is another slide from InvestmentNews, 2017 Comp and Staffing Study. Professional advisor outsourcing firms have already invested in staff and technology to add scale to efficiently service their RA and advisory clients. So even their staff is being taken care of with payroll and benefits and everything else. So that's something you as a firm wouldn't have to consider if you outsource. So this is a slide again of some of the key HR staff of an ensemble RA firm. And the point of this firm, this slide, is for you to see the actual compensation if you were to spend time and energy finding competent staff to fill these roles. Collectively, it's a lot of money versus hiring a back office outsource company, at a fraction of the cost. And just to drive this point home even further, here's a summary of the total cost to hire individually, and this doesn't include payroll tax, the time associated with finding the right people, training, etc. It could be quite time-consuming, and some of them may not even work out. So as you transition from a solo practitioner towards a super ensemble or ensemble, it could cost over $1 million to pay for human capital to support your growth. Again, one solution is to hire a professional management company who can take on these roles and take on the roles at about 4 to 7% of revenue, so significantly less than hiring them individually. And so what we'll do now is have Dan Cronin, my partner, discuss how to bridge the gap relative to the HR challenge in the next several slides.
Thanks very much, Chad. Hello, everybody. So the question here is, how do you bridge the gap? How do you create capacity so that you can achieve higher growth and margins? And that's a topic I'm going to try to cover here in the next few slides. So the RA market, as we know, has been growing at a rate of about 10 to 15% each year. And that's over the last 2 decades. But the market does show some signs of maturing as far as the growth rate. 2016 growth rate came in at about 5%. Again, referring to the same InvestmentNews comp study, 20% of more than 320 firms in the survey said they were already at capacity and they can't grow anymore. Another 69% said they're getting close to that. Shad and I thought about that. We think that's just an amazing stat. 90% or close to 90% of firms are either at capacity or close to capacity. And we don't think it's because they can't find new clients, it's because they can't profitably service new clients due to the cost of adding more staff. It's all about scale, and we know that larger firms, and this is according to Charles Schwab's 2017 RIA benchmarking study, they have more revenue per client with less clients per professional. So for example, firms with assets under management between 100 million and 150 million have approximately 53, or an average 53 clients per professional, and $376,000 in revenue per professional. If you contrast that with larger firms that have AUM over 2.5 billion, those firms benefit by having almost double the revenue per professional. It's 739,000 as the figure. These firms actually have a lower client per professional figure at about 45. So the key to profitability is to create growth. But in order to grow, almost every firm in the survey first needs to create capacity. So as an advisor or principal, if you find yourself being dragged into the back office work of your firm, it may be that you're wearing too many hats. So what does a professional advisor management company offer? When you think about outsourcing the independent market, in the independent market, one way to move the needle is to consider hiring a professional management company or platform. We know every advisor already outsources critical business functions to third-party firms. As we all know, very few independents create their own performance reports. They use leading portfolio management companies such as Black Diamond, Orion, or Adipar. They outsource estate planning, legal, and compliance to third-party firms that typically specialize in managing only one segment of an advisor's operations. A management company should take on important business operations tasks, which will then be performed by very experienced RA operators and tied together via professional CFO function. Let's take a quick look at the sectors and services that you should consider outsourcing to help you avoid hiring additional professionals. And that, of course, would result in higher expenses. For advisors looking to break away or existing firms that are seeking to attract new advisors to tuck into their firms, the 4 categories on this slide can be handled in a more cost-effective way using a management company instead of doing it in-house. So some of these are optional, but some firms will require all 4 of these categories. They include startup, financial, and capital projections. What we do is deliver those in a detailed 1- and 7-year pro forma report. A pro forma is extremely valuable whether an advisor even hires us or they decide to go their own way. Next step would be transition planning, which often includes custodial search and negotiations, and Shad and I both have a lot of experience doing this in previous roles. Obviously, office space, those services are not something that an existing firm may need, but it's necessary for all new entrants into the RIA space. And advisors leaving a wirehouse or a very well-known brand firm, they'd do pretty good, or I think they'd be smart to stay out of the commercial office space negotiations. It's better to spend time focused on your clients right before you break, and it's a good idea not to expose your names to commercial office brokers. The word can get out, and you don't want your complex manager to find out. So our firm handles everything from lease negotiations, interior design, all the furniture and technology installs, as I like to say, right down to the artwork and the Keurig machine. We can outfit an office to advisor specs and have it ready to go before they ever step foot in it. You know, marketing is something that many firms outsource already, but it makes sense in many cases to coordinate that through an advisor management company that has a CMO function. It runs the gamut from branding, logo design, website development, public relations, collateral, and more. For a mature advisor business, this step would be more of a marketing review and potentially a refresh of your firm's brand and look. Now, one thing going back to office setup, it's critical for all advisory firms that your servers, your hardware, and routers are all set up properly so that your firm's internet access is consistent, that it has the proper backup, and most importantly, keeps malware and cyber attacks out of your files. We were out at, I think it was the Schwab conference recently. Our head of advisor IT explained to us that there's a new class of routers now available, and they're engineered to monitor and protect your firm's digital traffic before the infected files reach your servers and hardware. We make sure all our clients have this new level of digital protection, so that's something to really think about if you haven't already taken the step to do that. Now let's dive a bit deeper and talk about legal and compliance, finance and accounting, HR, and technology. All advisor firms spend money on these 4 categories. If you're an advisor that's transitioning or you're thinking about a change, you might already have an attorney that specializes in the RIA registration process. And that firm probably also provides ongoing compliance. It's important that your contracts are reviewed by an attorney that specializes in the RIA practice model. That attorney will be able to guide you through today's best practices with respect to moving your business to your own independent firm or to tuck in. And they should be total experts on the broker protocol agreement and the recent changes that are making headlines right now. They should also be able to create the legal entity, prepare your operating and client agreements, and complete your filings. This can be a very expensive step, so consider using an experienced partner to determine the best balance of fees versus value. And then as far as ongoing compliance, it's really table stakes for any independent firm. We recommend a high level or platinum level of compliance services, at least for a firm's first year in business. After that, it may be okay to drop down to a standard compliance arrangement. Our firm works with some of the top RIA legal firms in the space, and we've customized our offerings so that we can offer significant compliance support and partnership with these top firms. This ends up resulting in, I think, lower costs and increase in services our clients will have access to us as their first line of defense. Now, for finance and accounting, I wanted to highlight a proposal we delivered just this week, which includes a very detailed list of deliverables just in the finance and accounting category alone. This is an area we specialize in with former CPAs on staff. Just for our controller services, we do the following: vendor management, accounts payable processing, bank and gain loss reconciliation, cash flow projections, and client billing and reconciliation. We also do the payroll processing. And then for financial statement prep, we do that, and also tax compliance. We include monthly preparation of the firm's financial statements to include P&L, actual to budget, along with variance reporting, balance sheet, cash flow projections. We do the supporting financial schedules, and we act as a liaison to our advisor's tax professional firm. And then with respect to preparation of budgets and budget reporting, we prepare an annual budget report and a monthly report for advisors. We detail actual to budget, and then we include the variance reporting. And something extra that we do, we maintain KPIs or key performance indicators that are beneficial to our clients. It also helps us to continuously improve. KPIs that we feel are most important for advisors are, of course, overhead costs, operating profit, revenue per professional, AUM growth, product mix, and client mix. I'm just going to touch on HR and payroll. That category can take up an inordinate amount of valuable time for many advisor professionals, and even owners get drawn into this vortex. So examine what you're doing in that category. That's something that an outsourcing company should be helping you with. Lastly, our firm will support our clients with building their own fintech stack. This includes portfolio management and accounting software, financial planning platforms, CRM, you name it. And in addition to that, we provide a turnkey office technology solution, including the communications phone systems, MS Office, data warehousing, IT support, and more. So a little bit about True Clarity. We're backed by a 27-year-old family office based in Tampa, and the firm has a history of finding talented individuals and then providing the capital and then the operational expertise to help them run their business. The key point is that whenever you choose an outsourcing partner, look for a solid financial backing and years of experience with seasoned operators. So in closing here, as Shad mentioned earlier in the presentation, top performers, they enjoy about a 21% higher margin than all other firms combined. They do this by keeping their overhead below 30% of revenue. By adding the savings back to your bottom line, it will also help maximize your enterprise value when it comes time to implementing your succession plan. So to wrap it up, I'd like to review one key statistic that was highlighted again earlier by Shad. We use this all the time in our conversations with advisors because it gets right to the heart of the matter. Cerulli's research details that 46% of an average advisor's time is spent on non-client-facing, non-revenue producing tasks. Just about half an advisor's time is spent on tasks that just don't add any revenue to the firm. So I think a worthy goal for every advisor is to consistently monitor their total overhead expenses and make it a business goal for 2018 to get that figure to 30% or less. Thank you all very much for listening, and now Shad and I will answer any questions.
All right, terrific. Thanks, Dan. Thank you, Shad. That was actually very, very interesting. I'm sure a lot of people are thinking, how can I get my, how can I make sure that my expenses are in line with where I needed to be one of these top performing firms? So a couple of questions came in. Jim asked, what are some of the first services that most firms outsource?
So,
can you guys hear me?
Yeah, can you hear me okay?
Yeah, sure. I'm just gun shy now because of earlier.
Yeah, no problem. This is Shad Vesikoff. One would be compliance. Two is the billing and vendor management, so like the P&L management and paying all the vendors and managing the vendor process. And then the third would be technology, the technology stack. That's from my experience. Dan, would you agree, or do you have any other thoughts there?
I agree with those, but you always see with respect to technology, every single firm now is outsourcing their tech stack. So all that's done by technology firms that are focused on the RA side. But when you go outside of that, the usual, then I think the compliance function is now that's something we're hearing a lot. it's causing a lot of pain with many firms, and they're looking for ways to reduce that cost. I think just the finance and accounting, some firms do a great job at that, but I would say that it's that 75% of them can improve in that area, and that can really help get the cost down and the bottom line.
Okay, terrific. So here's a second one. What are some of the core competencies that should never be outsourced?
That's a really good question. If you are the type of manager that feels very confident in your ability to manage money, and that's something you enjoy doing and you're good at, that may be one in my mind. My personal opinion on that is the more you can outsource so that you can focus on the growth and profitability of your business, the better. And the more tasks you take on in terms of trying to, pick stocks, and you may enjoy it, and that's one thing. And there's plenty of great advisors that love doing it and will never give that up. But it does take time away from actually going out and prospecting for new business and, all the other things, and marketing and all those things associated with that. So I would say if you love it and you're good at it, then don't outsource it. On the flip side, if it's not core to your capabilities and your expertise, then you should outsource it. So Dan, what do you have a different opinion, or what are your thoughts?
No, I agree with that, but something that I saw recently kind of is maybe take a step back, and I read where some of the custodians are building bots to actually answer questions for advisors' clients. And I resolved to myself that the first time my advisor has a bot answer my question, then I don't see why I would work with that advisor anymore. I think the real value of the advisor is spending valuable time directly interacting with your clients. I would never outsource that. That's what I'd be looking at all the time. Say, how can I get more phone time, FaceTime, work time with my clients, just to build up and really help them. Joe Duran from United Capital, who we respect a lot, he talks a lot about advisors helping their clients have honest conversations, and they bring in, partners, husband and wife teams, etc., and they sit them down and they talk to them about their business, about their family and the values and what each of them wants, and they do it separately, and it's amazing what they find out. So I think that's unique, and I think that's something that I respect, and so my answer would be don't outsource any of your interactions with your clients in any way. And we stay out of that. We do all these things. We do all the other things.
Dan and Chad, on that topic, this is Terry. Is there a point at which an advisor, even if they like doing the management of money and picking stocks, et cetera, where they shouldn't, and if they have over a certain amount of AUM, that it may make sense to do it? Because clearly it takes time to do that. It may, there's a lot of other things that they could be doing, but for firms that get to a certain asset level, does it make sense to start to think about doing that in-house?
I'll answer that one. I think that it only makes sense if they're not delivering results, and if they have a passion for it, if it's part of why the advisor got into this business in the first place, and they're doing a good job and the clients like it, then there's many successful firms that have an in-house investment management function, whether they're investment managers on their own right or they're actually picking managers, third-party managers. That can work very well regardless of the size. But it is something to consider outsourcing if you're just managing to beta, indexing ETFs. It makes a lot of sense then potentially to go with the lowest cost solution, or at least in a platform that can deliver that in a very efficient manner.
Yeah, and I'll answer that maybe a little bit differently. Is when you think about maximizing enterprise value, the more you can institutionalize your firm, the better off you'll be. And what I mean by that is, if there is one key partner or owner that is solely in charge of picking, buying, and selling stocks and has been doing it for years, that sort of intellectual capital will be hard to transition to the new owner, and therefore the valuations, and this is probably something you guys are really good at, it's not going to transfer well, so you may actually get a lower valuation as a result of that. The second thing, though, too, to consider is if you're earning 100% of your fee for stock picking and you suddenly outsource that to SMAs, separate account managers, you may be giving up some revenue by doing so, but you're also affording yourself some additional time. So there's kind of a trade-off between the two.
Yep, that's a great point that you made about the succession, because we often see people who who bring on successors that don't complement that, like having someone that is the stock picker and that's the value proposition that they've had, and bringing in someone that's not. It's not only going to give it a lower valuation, but the success rate is going to be challenged.
Agreed.
So there's one more question that came in, and this could actually be a great transition to the to Terry taking over the screen here, and that is that it says, can Truelytics help advisors understand where their costs may be out of whack with the rest of the market?
That is a
good transition for you, Terry.
Yeah. And by the way, Kevin, thank you for hosting, and Dan and Shad for your comments. Absolutely, we can help, and I will walk through that, because we do have the ability to benchmark and show you where your costs may be out of line with your peers and also with the market. And I think it's important to note that our mission at Truelytics is to help business owners in the wealth management space more effectively value, benchmark, and strengthen their business. We're agnostic to how you affiliate, whether that is as an independent RIA, a tuck-in with another RIA, a broker-dealer, or a wirehouse advisor. We want to be able to help, well, wirehouses aren't independent business owners, but that's the right place for many advisors. But for independent business owners, we have software that I will walk you through briefly that will give you some really good information, including what the potential value of your business is, as well as the underlying non-financial factors and how they impact valuation. When you come into our software as a service, which is $1,075 for advisors that are not affiliated with enterprises that work with us. We're going to ask questions on 7 areas of your business, about your firm, your ownership, advisors, clients, process, revenue, and financials. That will then generate a discounted cash flow valuation under the discounted cash flow, 5-year discounted cash flow valuation methodology. It will give you a score or a grade on your business, and then it scores your business, client, and market stability with the potential impact that has on your valuation, meaning if you had A's in business and client stability in this example, you would potentially increase that by over $700,000. Very briefly, I'll go through some of the questions that we ask. So we find out when you were established, how you're structured, how you register with the SEC, how many owners, advisors, who your custodians are, and your broker-dealer. We'll capture information on the owners, what percent they have, how old they are, and whether they're advisors or not. Same thing with advisors. Then we get information on your clients. How many do you have? What's your AUM? What's your average client age? How many years have they been with you on average? How many do you add and lose each year? How do you acquire your new clients? What percentage do you get through referrals? What percentage of your relationships, what percentage of your AUM is with your top 5 relationships? Do you do institutional business? Do you have a relationship with the next generation? And how often do you meet with your clients? These are all things that go into the that have an impact on a discounted cash flow valuation. Then we capture information on your processes. Do you have emergency, continuity, and succession plans in writing? It's surprising to me that 80% of advisors do not have a formal written emergency continuity or succession plan. Do you have non-compete or non-solicits with your advisors and professional staff? Retention programs. We capture the information on all of the technology. So we capture your technology stack, which not only goes into the valuation, but also for those that are looking to acquire other businesses, helps them to understand if there are going to be integration issues or significant increases in costs. Capture information on the revenues, growth rates, what is recurring and reliable, and whether you have discretion. And then we find you tell us what the breakdown of the revenue by product area. And then the last screen are your financials. We take the line items off of your P&L. We get 5 years of revenue. That gives us your historical growth rate, add backs and adjustments, assets and liabilities, and hit save and finish. And you are done. It gives you your score, in this case, on a $165 million business to 2.33 with a $4.1 million discounted cash flow valuation. Business stability, client stability, market stability score. We show your P&L, your valuation ratios, so you'll be able to see where you stack up against the numbers that Shad and Dan went through. We're very transparent on the discount rates, so you can see how we're discounting. And then we give you a scorecard that shows you where and what the potential impact is because of the score. Not having a continuity plan or non-competes or succession plans, being solely reliant on referrals as the way to acquire new clients. That is a negative. As a matter of fact, it's one of the surprising points for many advisors, because they've been told their entire career that they should build their business getting referrals, and that's not necessarily, it's true. However, it's not necessarily the best thing if you're looking to sell your business, because the new owner is going to have to get those relationships, so they're going to discount that future cash flow because of that. So we give you your scorecard. We also show you what it would be under other methodologies. We believe a discounted cash flow is a very, very good measure for these types of businesses, but it's not the only one. And we show it under multiple of revenue, EBITDA, and EBOC, with the industry multiples that are associated based on AUM. So if this were a business that had $1 billion in AUM, you would see that those multiples would be significantly higher than the 3 to 3.8 multiple. We just turned on the benchmarking, so now you can go in and see where you stack up in terms of what your score is versus your peers, and that is plus or minus 25% of AUM, and also what the market is. Same thing in value, and it shows you what you are potentially losing in value versus your peers. And then we turned on the expenses, so you can see where you stack up with your peers, and you can look at it on line items. So if I want to look at what my marketing and business development expense was versus my peers in the market, I can see here that I am this firm's spending less than their peers and less than the market on marketing and business development. That may be an indicator of why they are underperforming or not growing as fast as the market. So it gives you the ability to look at it on any of the categories that we are capturing, whether it's rent, technology spend, etc. We do have the ability for enterprises to see their enterprise data. So I can tell you in our universe of over 800 firms, just looking at one, for example, CRM, Redtail is the #1 CRM across the universe of our firms. But interestingly enough, if you just look at the smaller end of the market, it's even more pronounced, Redtail being the largest. But if we then just look at very large firms, you'll see that Juncture and Salesforce are the two biggest. We're able to now take this data, overlay machine learning and artificial intelligence, and we will start to be able to come up with trends that are happening. And I don't know what they're going to be yet, but it could be something along the lines that people that use Salesforce grow faster or slower than people that use Redtail, or people that use Redtail in conjunction with MoneyGuide Pro or an Orion are more profitable than other firms that don't. I don't know what it's going to tell us, but we do know that the data is going to start to tell us some very interesting things. So getting back to Truelytics, our goal is to help independent business owners maximize their value, to be transparent or agnostic to how you do that, but want to be the source for truth in the industry. So Kevin, with that, I'll turn it back to you and see if there's any questions and let you close up and get people back to their day.
That's right. So, well, thanks, Terry. That was great. And the benchmarking stuff is a great way to be able to tell whether or not you're in line with the marketplace and your peers and what you're spending. And I think that sort of feeds right into the Trueclarity thing. Hey, Dan and Chad, there are a couple of questions that came in on your end since we're finishing things up. Do you guys handle, the first one is, do you guys handle administrative matters like client paperwork at the custodial level with your services that you offer?
So we would do that. Sometimes we do that on a project basis once an advisor's on our platform and transitioned. But we do it on for advisors in transition. So that's something we help with.
Gotcha. Okay. And the other thing was, and I'm sure this is with the transition period as well. Do you help recruit new staff?
We will help source new staff, and we will try to whittle it down as much as we can, and then sort of turn it over to our advisors to make the final selection. But yes, we do help with that.
All right, fantastic. Well, guys, this has been great and very insightful, very interesting. Yeah, sure.
Kevin, can I just make one final point, because of the fact that we're talking about if it makes sense. One of the things that people can do and use our software for is to do some of the analysis of if it makes sense to use a professional services firm like Trueclarity. So if I was looking at my financials and I could save money because I don't have to have a staff, or I could reduce my staff in half, and my marketing expense was going to go down because of that, I can start to look at what the impact is going to be for that, and as long as I hit save and next, save and finish, it will recalculate the score. If I was going to be able to grow faster because I am now not spending 15 hours a month or a week on something, and I'm now able to grow at a higher pace because of that, we will show you, the software will show you exactly how that impacts your potential valuation. And as you can see from it recalculating, you got an increase in that. Mm-hmm. So you can use it for doing some scenario planning as well.
That's a great point, and one of the reasons why we enjoy partnering with Truelytics. So thank you, and we invite anyone who wants to do this to contact us. We'll be happy to do it with you.
Excellent.
Fantastic. Well, guys, it's been very, very insightful and I think very interesting, and we appreciate your time today. And to everyone listening, enjoy the holidays and have a great new year, and we will see you in 2018. Thanks so much.